Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Welcome back. In Part 1, we covered the risks of cash-only retail chains. Now in Part 2, we'll focus on safer investment strategies, how to evaluate retail companies, and what to watch for in their financial and operational reports. More pressure from banks, regulators, and card-first shoppers. In 2026, many shoppers expect to pay with cards, tap to pay, or mobile wallets. Cash-only policies add friction, and friction hurts conversion. Even customers who carry cash might choose a competitor if it's easier. Cash-only can also strain banking relationships. Banks often want clear documentation and predictable deposits. Vendors and landlords may prefer electronic payments. Payroll is usually electronic, too, which means cash intake still needs to move into the banking system regularly, with strong records. Regulatory pressure can also rise in certain categories. Rules can change, enforcement can tighten, and compliance costs can jump. That doesn't require wrongdoing to become expensive. A company might need better reporting, stronger controls, or new processes fast. Some cities and states push for cash acceptance to protect consumers who don't have bank accounts. That's a different issue. A law that says, you must accept cash, doesn't make cash-only a growth plan. Cash-only can still limit expansion, especially in areas where customers expect modern payment options. Red flags that a cash-only chain may be one to avoid. You don't need inside info to spot trouble. Most warning signs show up in filings, earnings calls, store economics, and plain customer experience. The key is to look for patterns, not one-off drama. Start with a simple question. Does management talk about controls the way a serious operator would? Clear language, consistent metrics, and stable reporting matter more than hype. If the story keeps changing, or every quarter has a new excuse, investors should slow down. Also pay attention to how the company responds to basic questions. What's driving same-store sales? What's happening with shrink? Are deposits and inventory tracked in a way that scales? A cash-heavy chain should have strong answers here. If it doesn't, risk rises. Financial warning signs. Odd margins, weak cash controls, and frequent, one-time, issues. Some red flags pop out once you compare a few quarters and read the notes, not just the headlines. Watch for inconsistent same-store sales that swing without a clear reason. Retail can be seasonal, but sharp moves deserve an explanation that fits the facts. Another signal is a big gap between reported profits and operating cash flow. A mismatch can happen for normal reasons, but repeated gaps can hint at timing games, working capital issues, or weak collection and deposit processes. Inventory is a common trouble spot. Sudden inventory jumps, big write-offs, or confusing inventory language can point to tracking problems. If shrink is rising, or management avoids the topic, treat that as a serious risk, not a footnote. Also note governance and reporting hygiene. Auditor turnover, late filings, and repeated, material weakness, or control language should stop you in your tracks. Same for complicated related party deals that make it hard to tell who benefits. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.